In March 2023, Silicon Valley Bank collapsed in 48 hours, the 16th largest bank in America. Gone. Regulators seized it on a Friday morning. By Monday, JP Morgan was already buying the pieces. If you think this was a random bank failure, a freak accident, or the result of incompetence, you're wrong. This was a playbook. The same banking families that created the Federal Reserve in 1913 just executed Move 3 of their crisis playbook. They've run this exact sequence before, in 1907, in 1929, in 1987, in 2008, and now in 2023, they're running it again. Here's how 12 families use financial crises to consolidate power and wealth. Here's the pattern they've been running for 111 years. And by the end of this video, you'll see it so clearly, you'll wonder how you ever missed it. The Banking Cartel Playbook section. Part 2. The Playbook Framework. This is what I call the Banking Cartel Playbook. It's a 4-move strategy used by the same banking dynasties to profit from every major financial crisis since 1913. Here's how it works. Move 1. Create the artificial boom. Flood the system with cheap credit. Make everyone feel rich. Encourage maximum leverage and risk-taking. Move 2. Signal the insiders. Quietly warn the families and connected players. They exit positions early. They move to cash and hard assets. The public keeps buying. Move 3. Trigger the collapse. Tighten credit. Raise interest rates. Let the panic spread. Watch the system implode. Move 4. Consolidate the wreckage. Buy the assets at pennies on the dollar. Absorb the failed banks. Expand the empire. Repeat. This isn't a theory. This is documented history. And it's been running on a loop since the Federal Reserve was created. They don't cause crises by accident. They engineer them. Let me show you how this works, starting with a crisis that created the system itself. The origin. 1907 and 1913. Section 3. The origin story. October 1907. The panic of 1907. Bank runs across America. The stock market crashed 50%. Economic chaos. Businesses failing. People losing their savings. And then a hero emerged. JP Morgan. He personally organized a coalition of bankers to inject liquidity into the system. He saved the economy. The public was grateful. The newspapers praised him. Politicians thanked him. But here's what really happened. Morgan and his banking allies created the panic. They spread rumors about specific banks to trigger runs. They called in loans to create liquidity crunches. They orchestrated the crisis. Why? Because they needed a problem to sell their solution. The solution was a central bank, a private institution that would control America's money supply, and they would own it. The public, terrified of another panic, demanded stability. The bankers offered them the Federal Reserve. But the Fed wasn't created in Washington. It was designed in secret on a private island by the most powerful banking families in the world. Jekyll Island, Georgia, November 1910. 7 men met in secret at a private hunting club on Jekyll Island. They traveled under fake names. They told no one where they were going. Who attended this meeting? Representatives of the Rothschild banking dynasty from Europe, the Rockefeller family, JP Morgan's interests, Paul Warburg of the Warburg banking family, Frank Vanderlip of the Kuhn Loeb banking house. These men represented 1/4 of the world's wealth. And they spent 9 days designing the Federal Reserve System. They wrote the legislation. They structured the ownership. They built the entire framework. Then they brought it to Congress and sold it as a government institution designed to protect the American people from panics like 1907. It was a lie. The Federal Reserve is a private corporation owned by member banks. It has never been audited by Congress. It operates outside government control. And on December 23, 1913, while most of Congress was home for Christmas, the Federal Reserve Act was passed. President Woodrow Wilson signed it into law. Years later, he would write, "I am a most unhappy man. I have unwittingly ruined my country." The banking cartel now controlled the U.S. money supply. They could create booms. They could trigger busts. They could engineer crises. And they had the legal framework to do it forever. But the Jekyll Island meeting was just the beginning. What they did next changed the world forever. Section 4. The 12 families. So who are these families? Let me name them. The core banking dynasties, 1913 present. The Rothschild family, European banking dynasty, estimated wealth over $500 billion, financed governments and wars for 200 years. Instrumental in creating central banks across Europe and influencing the Federal Reserve's design. The Rockefeller family, oil empire that became a banking empire, visible wealth around $11 billion, but true influence is far larger. Founded Chase Manhattan Bank, now part of JP Morgan Chase, the Morgan family. JP Morgan's lineage, created the blueprint for modern investment banking. Today's JP Morgan Chase is the largest bank in America. The Warburg family. Paul Warburg designed the Federal Reserve structure at Jekyll Island. His family controlled major European banks and influenced American finance for decades. The Kuhn, Loeb and Kummer dynasty. Jacob Schiff and his descendants. financed railroads, industries, and governments, merged with Lehman Brothers in the 1970s. The modern power players, post-1980, Goldman Sachs leadership families, not a single family, but a networked dynasty, Hank Paulson, Lloyd Blankfein, Robert Rubin, they rotate between Wall Street and government, the Lehman family. Before the 2008 collapse, the Lehman dynasty controlled massive financial assets. The collapse was part of the consolidation, not an accident. The Lazard family, investment banking dynasty, Lazard Frères advised on every major corporate merger and government bailout for a century. The Schiff, Harriman, Vanderlip, and Davison families, the secondary tier of the Jekyll Island conspirators. Their descendants still hold influence in banking, investment, and Federal Reserve policy, the modern institutions. They control the Federal Reserve itself, directly owned by member banks, J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo, the too-big-to-fail banks, BlackRock, Vanguard, State Street, the big three asset managers. They control $20 trillion and are the largest shareholders in almost every major corporation. And here's the critical point. BlackRock and Vanguard are the top shareholders in each other. They sit on each other's boards. They coordinate. These aren't conspiracy theories. These families' roles in creating the Federal Reserve are documented in congressional records, Federal Reserve archives, and their own memoirs. Paul Warburg's son, James Warburg, testified before Congress in 1950 and said, "We shall have world government whether or not you like it. The only question is whether that government will be achieved by conquest or consent." They've never hidden it. You just weren't looking. Now let me show you the playbook in action. Starting with the first great crash after the Fed was created, 1929. The playbook begins section 5, the 1929 crash. The Roaring Twenties, 1921 to 1929. The greatest boom in American history. Stock prices doubled, then tripled. Everyone was getting rich. Ordinary people were buying stocks on margin, borrowing 90% of the price. The economy was booming. Unemployment was low. Consumer spending was exploding. It felt like prosperity would never end. But behind the scenes, the Federal Reserve was executing Move 1 of the playbook. Move 1, create the artificial boom, 1921, 1929. The Federal Reserve kept interest rates low throughout the 1920s. Cheap credit flooded the economy. Banks lent recklessly. Margin trading reached insane levels. You could buy $1,000 of stock with just $100 down. Leverage was 10 to 1, sometimes higher. The stock market became a casino, and the house was the Federal Reserve and the banking families who controlled it. By 1929, stock valuations were detached from reality, but the public kept buying. The boom felt unstoppable. And then, in early 1929, something changed. Move 2, signal the insiders, early 1929. In February and March 1929, the banking families started selling. Quietly, discreetly, no public announcements. J.P. Morgan's firm reduced stock exposure. Rockefeller interests moved to cash. The Warburg family exited positions. Bernard Baruch, one of the most connected Wall Street insiders, sold his entire stock portfolio in early 1929. He moved everything to cash and gold. When asked later why he sold, Baruch said he saw taxi drivers and shoeshine boys giving stock tips. He knew the top was in, but the public didn't get the memo. They kept buying. The insiders let them. Move 3, trigger the collapse, October 1929. In August 1929, the Federal Reserve raised interest rates. Credit tightened. Margin calls started cascading. Investors who borrowed to buy stocks were forced to sell. Selling triggered more selling. October 24th, 1929, Black Thursday. The stock market crashed. Panic selling. October 29th, 1929, Black Tuesday. The market collapsed 12% in a single day. By November, the market had lost nearly half its value. Billions of dollars of wealth evaporated for the public. But the banking families had already exited. They were sitting on cash. Move 4, consolidate the wreckage, 1930, 1933. While the public was devastated, the banking families went shopping. They bought real estate at 10 cents on the dollar. They bought businesses at fire sale prices. They bought entire industries. Thousands of small banks failed during the Great Depression. Over 9,000 banks collapsed between 1930 and 1933. Who absorbed them? The cartel banks, J.P. Morgan, Chase National Bank, National City Bank, now Citigroup. The Rockefeller family expanded their empire massively during the Depression. J.P. Morgan's wealth and influence grew. The Great Depression lasted a decade for ordinary Americans. For the banking cartel, it was the greatest wealth transfer in history, and they knew exactly what they were doing. Congressman Louis McFadden, chairman of the House Banking Committee, said in 1932, "It was not accidental. It was a carefully contrived occurrence. The international bankers sought to bring about a condition of despair here so that they might emerge as rulers of us all. McFadden tried to impeach the Federal Reserve Board. He tried to expose the cartel. He died in 1936 under suspicious circumstances after multiple assassination attempts. The playbook worked. The cartel consolidated power, and they would run it again. But 1929 wasn't the last time. They ran this exact playbook again in 2008. And here's where it gets even more blatant. 2008. The playbook repeats. Section 6. The 2008 financial crisis. The early 2000s. The housing boom. Home prices were skyrocketing. Everyone believed real estate only goes up. Banks were giving mortgages to anyone with a pulse. No income verification, no down payment. Subprime loans exploded. Wall Street packaged these toxic mortgages into complex securities called CDOs and sold them to investors worldwide. The economy was booming. Again. And behind the scenes, the Federal Reserve was executing Move 1. Move 1. Create the artificial boom, 2001-2006. After the dot-com crash in 2000, Federal Reserve Chairman Alan Greenspan dropped interest rates to 1%, the lowest in decades. Cheap credit flooded the housing market. Mortgages became incredibly affordable. Home prices doubled in 5 years. Banks weren't just lending. They were leveraging 30 to 1, some even 40 to 1. For every dollar of capital, they held $30 or $40 in risky assets. The big banks knew this was unsustainable, but they kept lending because they knew what came next. Move 2. Signal the insiders, 2006-2007. In 2006, Goldman Sachs CEO Lloyd Blankfein sold a significant portion of his own company's stock. At the same time, Goldman Sachs was secretly betting against the very subprime mortgages they were selling to their own clients. Internal Goldman Sachs emails later revealed in congressional hearings showed executives calling their mortgage products shitty deals while selling them to pension funds and investors. JP Morgan executives quietly reduced their exposure to mortgage-backed securities in 2007. Hedge fund manager John Paulson, deeply connected to the banking cartel, created a fund in 2007 specifically to short the housing market. He made $15 billion when it collapsed, but the public kept buying homes. The insiders let them. Move 3, trigger the collapse, 2728. The Federal Reserve raised interest rates. Adjustable rate mortgages reset to higher payments. Defaults began. March 2008, Bear Stearns, one of the largest investment banks, collapsed. JP Morgan bought it for $2 per share, down from $170 a year earlier. September 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy in U.S. history. The stock market crashed 50%. Trillions of dollars evaporated. Millions of Americans lost their homes, their jobs, their savings. But the cartel banks knew it was coming. Move 4, consolidate the wreckage, 2008-2010. September 2008, the federal government announced a $700 billion bailout package called TARP, taxpayer money to save the banks. Who got bailed out? Goldman Sachs, JP Morgan, Bank of America, Citigroup, the cartel. Goldman Sachs received $10 billion, but they had already made billions secretly betting against the mortgages they sold. Then, in 2009, Goldman Sachs paid $16 billion in employee bonuses, with taxpayer bailout money. JP Morgan bought Bear Stearns and Washington Mutual for pennies on the dollar. They consolidated massive assets. Bank of America absorbed Merrill Lynch. Wells Fargo absorbed Wachovia. The big banks got bigger. Hundreds of small and regional banks failed and were absorbed. And here's the key move. BlackRock, the asset management giant, was hired by the Federal Reserve to manage the crisis. BlackRock, deeply connected to the banking cartel, was paid by the government to fix the crisis the cartel created. The playbook worked again. The cartel consolidated more power, and the public paid for it. And now in 2023, they just ran it again. But this time, there's something different. Something that proves the cartel is more powerful than ever. Toolline 23. The playbook accelerates. Section 7. The 2023 crisis. 2020. The COVID pandemic. The Federal Reserve dropped interest rates to zero. Trillions of dollars were printed. Stimulus checks, business loans, quantitative easing on a scale never seen before. Asset prices exploded. Stocks hit all-time highs. Real estate boomed. Cryptocurrency surged. Everything went up. It was the everything bubble. And once again, the Federal Reserve was executing Move 1. Move 1, create the artificial boom. 2020-2021, interest rates at zero. Money printing at record levels. The stock market doubled from its pandemic lows. Speculation was rampant. Meme stocks, NFTs, SPACs. Day traders became millionaires. Everyone felt rich. But by late 2021, inflation started rising. The Federal Reserve insisted it was transitory. They kept rates at zero. The boom continued into 2022, but behind the scenes, the insiders were preparing for Move 2. Move 2, signal the insiders, 2022. Throughout 2022, major banking executives and billionaires started selling. Warren Buffett, one of the most connected investors in the world, was sitting on a record $157 billion in cash by mid-2022, the highest in his company's history. Jeff Bezos sold billions in Amazon stock. Mark Zuckerberg sold billions in Meta stock. Bill Gates reduced equity exposure. Members of Congress who received classified economic briefings were caught making suspicious stock trades, selling before crashes, buying before bailouts. Bank executives sold their own company's stock. They knew what was coming. The public kept buying. Move 3. Trigger the collapse. 2023. In 2022 and 2023, the Federal Reserve raised interest rates at the fastest pace in 40 years, from 0 to over 5% in less than 18 months. Credit tightened. Borrowing costs exploded. The economy started cracking. March 8th, 2023. Silvergate Bank, heavily exposed to cryptocurrency, collapsed. March 10th, 2023. Silicon Valley Bank collapsed in 48 hours. $200 billion in assets, gone. March 12th, 2023. Signature Bank failed. Seized by regulators. May 1st, 2023. First Republic Bank collapsed. The second largest bank failure in U.S. history. The regional banking system was imploding. Stock prices for mid-sized banks were crashing. Panic was spreading. And then move 4. Move 4. Consolidate the wreckage. 2023 present. JP Morgan bought First Republic Bank's assets at a steep discount, backed by federal guarantees. The Federal Reserve created emergency liquidity facilities to backstop the big banks. Backdoor bailouts, without calling them bailouts. The cartel banks are absorbing the failures, getting bigger, consolidating more deposits. BlackRock and Vanguard are buying distressed assets. Real estate, corporate bonds, equity stakes. And here's what's different this time. The consolidation is faster. Silicon Valley Bank collapsed in 48 hours. In 1929, it took months. In 2008, it took weeks. Now it's days. The bailouts are hidden. They're called liquidity facilities and emergency lending programs. Not bailouts, but that's exactly what they are. The public is more aware. People see the pattern, but they're powerless to stop it. And the numbers tell the story. In 2023, the 4 largest banks in the U.S. control 45% of all deposits. After each crisis, they get bigger. That's not failure. That's the plan. The counter-argument section. 8. The counter-argument. Now let's address the skeptics, because I know what you're thinking. This is just capitalism. Markets go up and down. These are just cycles, not conspiracies. Let me respond to that. Skeptic argument. 1. These are just market cycles, not engineered crises. Market cycles exist, but answer this. Why do the same families profit massively every time while the public loses everything? If it's just a cycle, the losses should be random, but they're not. The cartel exits before the crash every time. Bernard Baruch in 1929, Goldman Sachs in 2008, Buffett and Bezos in 2022. That's not luck. That's information. Skeptic argument 2. The Federal Reserve is a government institution. No, it's not. The Federal Reserve is a private corporation owned by member banks. It has shareholders. It pays dividends. The Federal Reserve has never been fully audited by Congress, ever. It operates independently. When Senator Rand Paul proposed the Audit the Fed bill in 2012, it was blocked. Why? What are they hiding? Skeptic argument 3. These families don't coordinate. They compete with each other. Do they? BlackRock and Vanguard are the largest shareholders in JP Morgan, Bank of America, Citigroup, and Wells Fargo. BlackRock and Vanguard are also the top shareholders in each other. They sit on each other's boards. Their executives rotate between Wall Street and government. Goldman Sachs executives become Treasury secretaries. This isn't competition. This is coordination. Skeptic argument 4. This is just capitalism, risk and reward. Capitalism involves failure. Companies that take bad risks are supposed to fail, but these banks never fail. They get bailed out with your tax money. In 2008, the banks that caused the crisis were rescued. In 2023, the same thing happened. The game is rigged. Profits are privatized. Losses are socialized. You don't have to believe in a grand conspiracy. Just look at the pattern. Same families, same playbook, same outcome. Every single time. For 111 years. Pattern recognition isn't conspiracy. It's observation. What this means for you. Section 9. Implications. So what does this mean for your money, your future, and the next crisis? The timeline, based on the playbook. We're currently in move 4, the consolidation phase. Historically, this phase lasts 12 to 24 months. The next boom cycle will likely begin in 2025 or 2026. The Federal Reserve will cut rates, credit will flow again, asset prices will rise, the insiders will leverage up. They'll encourage you to do the same. The media will tell you it's different this time. And then, sometime between 2028 and 2030, they'll trigger the next bust. The pattern repeats. It always does. For your money. Watch what the insiders do, not what they say. When Warren Buffett is hoarding cash, you should too. When billionaires are selling stock, pay attention. When bank executives sell their own company's shares, that's a signal. Public filings show these transactions, you can track them. When the Federal Reserve starts cutting rates aggressively and flooding the system with credit, that's the boom signal. That's when the cycle restarts. When rates start rising sharply and credit tightens, that's the bust signal. Prepare for the collapse. The harsh truth: you can't beat the cartel. The game is rigged. The system is designed for them to win and you to lose. But you can stop playing their game. Hold cash during consolidation phases. Avoid excessive debt. Don't buy at the peak of the boom. Buy assets during the bust when prices are low and the insiders are accumulating. Not when the media tells you to. Reduce your exposure to the banking system. Diversify into hard assets. Gold, real estate, things they can't print or manipulate easily. The bigger picture: this system won't change until the public understands how it works. The cartel depends on your ignorance. Every crisis, they consolidate more power. Every bailout, they get stronger. Every cycle, the number of independent banks shrinks. The pattern is clear. The question is, what will you do with this knowledge? The Endgame Section 10, the payoff. Here's what most people miss. The banking cartel playbook isn't just about making money, it's about control. In 1910, there were over 20,000 banks in America. Small banks, community banks, independent banks. By 1929, after the first great crash, that number had dropped to around 15,000. By 2008, after decades of consolidation, there were fewer than 8,000 banks. Today, in 2025, there are fewer than 4,500 banks. After each crisis, the number shrinks. The big banks absorb the small ones. The cartel expands. By 2030, if the pattern holds, we'll be down to fewer than 1,000 banks. Maybe fewer than 100. The endgame isn't a financial system with many players. It's a financial system with one player: them. Every crisis is a step toward total consolidation, and they're not even hiding it anymore. JP Morgan CEO Jamie Dimon said in 2023, "This is a moment where consolidation is necessary for stability." Translation: let us absorb everyone else. The playbook has been running since 1913, 111 years, 4 moves, repeated over and over, and it's worked every single time. The only question left is, how many more cycles until they own everything? If you want to keep recognizing these patterns, the hidden playbooks that control nations, currencies, and your financial future, subscribe. Because the next move in this playbook is already being planned. The signals are already appearing. The cartel is counting on you not seeing it. Don't give them that satisfaction.